Thank you for joining AAFCPA's 2024 year-end webinar covering tax compliance and advisory services for cannabis operators. My name is Dave McManus, and I am a tax partner here at AAFCPA's, and I'm also the cannabis practice leader for AAFCPA's cannabis practice. This is an interactive webinar. We encourage questions at any time. There is a question function on your screen. And if we don't get to your question during the hour that we have together, we'll be sure to follow up with you afterwards. For those of you who are CPAs, this webinar does qualify for 1 CPE credit. And to be eligible for that credit, you must answer 3 of the 4 polling questions that will pop up throughout the hour session that we have. And you must stay with us for the entire hour, which it will be so exciting that you won't want to leave anyways. The slides will be available in the chat function if you'd like to download them. And we will also make this webinar, we are recording it, and it will be available afterwards for you to view again or to share with others. So that's some house cleaning items for everybody to abide by, and we're going to get going. So 2024 was a pretty monumental year for the industry when it comes to tax strategies that we've been talking to a lot of our clients about. And probably the most significant happening during 2024 was the DEA's recommendation to reschedule cannabis from Schedule 1 to Schedule 3 under the Controlled Substances Act. And even though that doesn't get rid of the federal illegality of cannabis, it does help in terms of tax relief in that IRS Code Section 280E will go away. So we've been talking to a lot of our clients about different strategies that they can explore and implement post a rescheduling world. And we're going to cover some of those today as part of our webinar. The other significant item was, I think everybody knows, back in early of 2024, Trulieve made an announcement that they received income tax refunds from filing refund claims for prior year tax returns, and that they were going to take a non-280E strategy on their filing going forward. So that was monumental for us. The phone was ringing off the hook when that happened. And we talked to all of our clients about different strategies and the pros and cons of taking a similar approach, as well as other tax strategies that we do talk to all of our clients about. So that will be covered in today's session as well. So without further delay, I invite our speakers to introduce themselves.
I'm Janice O'Reilly. I'm an advisory partner in the cannabis practice. In addition to working on cash flow, I'm also in the operational and strategic side through our new subsidiary CanCount.
Good afternoon, everybody. My name is Dave Gravel. I am a tax director within AAFCPA's cannabis practice, and I'm happy to be speaking with everybody today.
Hello, everybody. This is Tomas Puello. I'm one of our tax managers in our cannabis practice, and very happy to be with you guys today.
Good afternoon. I'm Josh England. I'm a tax partner and attorney here at AAFCPA's. I often consult with our cannabis clients on startup strategies and structure, as well as exit strategies.
Now, who doesn't want to improve cash flow? We would be remiss if we had anything in the cannabis space without talking about cash flow. So we've compiled some ideas throughout this presentation, both about ways to improve cash flow, particularly through tax optimization, and get us ready for an exit or potential exit. Who needs to do some cash flow analysis? Well, everybody really needs to. And one of the key things that I tell clients when they ask, how do you define what makes a company successful? And I say, well, let's start with their cash flow. And it's important not only to look on a short-term basis on the 13-week by week, but let's look out 2 years on a quarterly basis. This particularly comes into play with your taxes to make sure that if you're a C Corp, that you have the taxes you need the cash you need to pay your taxes. And even more importantly, we see issues with distributions if you're a pass-through entity. So we really try to make sure all of that's put into our cash flow projection so that we can expect what's going to happen depending upon what our gross margin is. We also try to look at benchmarking and look into best practices, and we really want to think about your tax optimization. I think we start with, let's look at efficiencies. We do have this new subsidiary CanCount, of which I'm the CEO of, but it's really to help tackle some of the operational issues and strategies and efficiencies. As we go out there with our tax advisory meetings or our outsourced accounting meetings or audit meetings, we really want to start looking at the companies holistically in a different way. We used to always look at it from financial and accounting, but a lot of the issues were more upstream. So we're really trying to take a very holistic view and support whatever strategic decisions you've made and make sure that that they're operational and that they're meeting benchmarking. And it's a good way to coordinate. We also like to compare you to market benchmarking data, but in particular, we want to start looking at your inventory area, your cost of goods sold, anything that's really going to help with optimizing your tax strategy. We want to keep in mind that your tax returns are based on your accounting records, so it's super important for your accounting records to be in good shape. For those of you who have been in the cannabis industry and subject to 280E for a while, we really struggle to make sure every client's looking at their allocations and what can you capitalize, what can you put into inventory if you're eligible for 471C. What else can you take a look at from an efficiency perspective to really try to optimize what your tax strategy can be, particularly now that we're still under 280E. Analytics can help with this. We can look at, particularly as I mentioned before, for distributions, or if you're a C Corp for your tax payments, for budgeting that out. Looking at metrics, how do I scrutinize? How's my sale data, my margins, compared to how I was in the past? How do I compare against my peers? So we really like to take a holistic view with you to try to maximize your cash flow, and particularly through gross margin analysis, since that's under 280E is our most important metric. Speaking of 280E, I want to pass this along to our tax director, Dave Gravel.
Thank you, Janice. Good afternoon, everybody. As Janice said, I'll be talking about 280E, what it is and what does it do. You know, if you spent any time in this industry, I'm sure you've heard about this code section 280E. But even if you're new to the industry or would like a refresher, I do have the code section up on screen here. It's a very small code section, considering all the other IRS codes, but it has a huge impact on this industry. And basically what it does is it disallows deductions for any companies that are trafficking in a controlled substance, specifically Schedule 1 and Schedule 2 of the Controlled Substances Act. And the Controlled Substances Act is managed by the DEA. So what this leaves a lot of cannabis businesses with is the ability only to deduct their cost of goods sold. And the reason why that is the case is because cost of goods sold are technically not deductions. They're adjustments to revenue or adjustments to your income. So it basically squeaks by 280E on a technicality, essentially. And what this does is it creates artificially high effective tax rates for businesses that are subjected to this code section, somewhere in the ranges of 70, 80, even sometimes 90% of your bottom line can effectively be going to taxes. It's probably one of the only industries I can think of that, this code section would have the ability to put you out of business and not be able to pay your employees or keep the lights on, so to speak. So now that I've painted that very rosy picture of doom and gloom, I do have some good news. It's not all bad. During 2024, as Dave mentioned previously, rescheduling is kind of on the table, and I've got a quick outline here of the timeline where we kind of starting in October 2022 to where we are today, kind of in the last two bullets there, we are waiting for the administrative law judge preliminary hearing to figure out who has, who our affected stakeholders are and who can be part of these hearings. That'll be held on December 2nd, 2024 at the moment. And then in January or February of 2025, that'll be when the projected final hearing is that will be conducted. So, assuming that this all goes well and we get cannabis rescheduled from Schedule 1 to Schedule 3, which just to explain really quickly, Schedule 1 is defined as any drug that has a high potential for abuse and no accepted medical value. Also on Schedule 1 are things like cocaine and heroin, in addition to cannabis. Whereas Schedule 3 drugs are considered items that don't have high potential for abuse and do have some medical value to them, which we know that definitely is where cannabis should be scheduled. It should be descheduled entirely, but for the moment, rescheduling to 3 is where we're at. So once all these hearings happen, then the DEA can make their final decision, weighing in all of the facts and circumstances from the Department of Health and Human Services, their own procedures, and as well as any of the items that they find out during the hearings. We do expect there to be litigations, no matter which way the decision goes, whether it goes for or against the industry. We do expect that there will be litigations. So even when the final decision is made, it definitely won't be the last time we hear about it in the news. One thing I want to talk about, and I will keep this non-political, I promise, is the 2024 presidential elections. I think this was really the first time that at least I can remember that both of the parties displayed their support for cannabis in a meaningful way. So hopefully come next year, the presidential elections will not be an impediment to the rescheduling. So as I said, we're basically waiting until January or February of 25, and a lot of our clients are like, well, what do I do now? What do I do between then and now? And we're really looking forward to the 2024 tax season, which will begin in 2025. Just remember, you're always a year behind when we're talking about tax filings. So the discussions that we're having with all of our clients is, what do we do? And essentially we see 3 options. The safest and least problematic, at least from a legal standpoint, is just kind of play the waiting game and do nothing. Wait to see what happens. Wait to see what happens with the rescheduling and the subsequent litigations, and simply continue applying 280E as appropriate. Moving up a little bit more on the risk factor. Janice mentioned earlier Internal Revenue Code Section 471C, which is the books and records method of preparing your taxes. Basically, this code section takes the power out of the hands of the IRS and puts it in the hands of the taxpayer. It's a very taxpayer-friendly internal revenue code, and it applies to small businesses. And small businesses are anybody that has less than $29 million of average annual gross receipts. So it's a pretty high bar, so to speak. So it's really just some of the largest operators in the industry that probably wouldn't be able to use this code section. So it is a conversation that we've had with all of our clients that qualify, whether or not this is something that they want to consider doing. And basically what it does is it says that as long as your tax returns are prepared in accordance with your books and records, IRS can't say that they're not accurately represented. So if we can use this code section to really move some additional expenses into cost of goods sold and therefore get them deductible on your tax returns, it's a very powerful internal revenue code. Moving further on up the risk factor, probably just about as risky as you can get, is really following in the footsteps of some of the largest MSOs, specifically TruLeave, as Dave mentioned earlier, and just kind of claim that 280 doesn't apply and should never have applied to the cannabis industry. This is extremely aggressive. IRS has actually come out and said that they are aware that a lot of these larger companies and cannabis businesses are taking this position and amending tax returns to say that 280E doesn't apply and requesting large refunds. And they've said that those returns aren't valid because they simply don't follow the code or the law, regardless of whether we agree with it or not. So if this is something that you want to consider doing, two things I want to mention here. One is we would recommend disclosing this on the tax return because it is an aggressive position. And the reason we do that is really as an insurance policy for the taxpayer. If the IRS were to come in and review your return, whether that be through a tax notice or an official IRS audit, and they would definitely overturn that position. By disclosing it, you would only be subject to the additional taxes and would not have to pay any additional penalties upon that change in taxes. You would have to pay interest. Interest is always a item to consider, but at least you don't have to be subject to some of those really, really high levels of penalties. The second thing that we would recommend is getting a tax opinion from a qualified tax attorney, just so that we can support the basis. We have a reasonable basis for taking this position. So again, if this is a stance you want to take for your 2024 taxes, make sure to be having that conversation with your advisors. As far as previous returns go, you've really got two options. One is to do the amended returns as Trulieve did. There is a slew of risks there that the IRS probably will disallow those amended returns and say that they're not valid. The other option is a little less risky, but it also means that there's less reward as well. So, and those are called protective claims, which are at their root just a request of the IRS to leave the tax years open, previous tax years open, and out of the statute of limitations, which is usually 3 years from the day you file. And basically what that does is it tells the IRS, there's a lot of kind of uncertainty right now. There's some pending lawsuits and litigations, and there's a potential for a constitutionality challenge for 280E. And with all those things, kind of all those balls up in the air, if these decisions go in the way of the industry's favor, which we hope they do, it still gives you the opportunity to amend your future tax returns, even if they may have fallen out of the traditional statute of limitations. So let's assume that everything goes well. The administrative law, the law judge in the DEA reschedule cannabis. Set the litigations aside for now. Let's say that cannabis gets rescheduled from Schedule 1 to Schedule 3. What happens? What does that mean? And what rescheduling does, the first and foremost, and probably one of the most important items for this industry is it removes 280E. 280E will not apply. And that'll be a retroactive application. I'm sorry, a prospective application from the day that that it gets rescheduled. It'll be from that point forward. So, and what does that do? I mean, that helps to level the playing field. Now everybody's kind of subjected to the same rules as non-cannabis businesses. It allows folks in this industry to be competitive, and really not have to worry about their tax bills putting them out of business. It also kind of increases the opportunities for research. I think a lot of the reasons why cannabis was on Schedule 1 to begin with was just the lack of research and folks not being able to, or the government and other institutions not being able to spend money on the research that it would take to prove some of these medical validations for cannabis. So it's kind of a catch-22. It'll also open up and allow some more sophisticated tax planning that a lot of our other non-cannabis clients at AAFCPAs are able to take advantage of. I won't delve into any of those details right now, as one of my other colleagues will be handling that in the next part of this presentation. But there's a few things that rescheduling doesn't do. And first of all, it's really important to distinguish between rescheduling versus legalization. Rescheduling is not legalization. Schedule 3 would still be considered an illegal drug. Therefore, banking and it would still be an issue. Your big banks such as Bank of America, Citibank, Wells Fargo still won't be able to bank the industry. So you'll be left with your more local state chartered institutions. Interstate commerce would still be limited, so you won't be able to move your products across state lines, and bankruptcy is still going to be off the table. So if you're struggling cannabis business, unfortunately, you won't be able to use the bankruptcy courts to kind of alleviate some of that pressure. Your options are really just closing the doors or going through a receivership process or some kind of turnaround process to either sell off all the assets and pay off the debts and close the doors, or to really turn around the business and to make it as profitable as possible. It also doesn't impact any previous incarceration. So folks that were charged with a previous cannabis crime, rescheduling won't overturn any of that. We would still be relying on pardons and other legal methods of getting those resolved. So that'll bring us to our second poll question, and I'll turn it over to Dave McManus just to see if he wants to add any other comments.
Yeah, thanks, Dave. That was a great summary of 280E and the rescheduling process. A couple of comments. One is when Trulieve made the announcement that they gave refunds out, like I said before, our email and phones were flooded with people calling to ask, does this make sense, and should this be a position that we should take? And why are we doing this? And the IRS in June did put out a memorandum that they're saying that they're not going to accept any refund claims, which makes sense. I mean, that's the IRS's job, is to enforce tax policy. But I think the key here is that the case in Canada provisions and the case that's going on out in Western Mass, that did go through. It got rejected by a local federal judge, and it's now in the appeals process. But that judge did say that, ultimately this, he couldn't make a decision because the only one that can ultimately make a decision on unconstitutionality around 280E is the Supreme Court. So the hope is that the Supreme Court does hear this case, and, whether the IRS accepts or rejects these refund claims or protective claims, I think it still protects you, and it's in your best interest to consider these options. So we have, like I said, been talking to all of our clients about what is the best strategy here. But regardless of whether you take a 471C position or a non-280E position, the key is that whatever you file in your returns, that position is disclosed, because it is contrary to the IRS regulations and rules. So the tax opinions are key, as well as the disclosures that are in the returns are key as well. And, we've been doing this for a long time, preparing returns with disclosures for quite a long time. And we don't see that as any indication that would increase a potential audit in this, for a return that was filed with that disclosure. The other thing I wanted to point out was AAF has been lucky to be invited to be on a task committee or task force with the AICPA to work with Treasury and the IRS around the implementation of the transition of 280E when rescheduling does come through. And, there's been a lot of questions about the timing of that. And, we're advocating with the IRS and Treasury about, if 280E goes away and cannabis gets rescheduled, say in the middle of 2025, our position is that the 280E would go away effective January 1st of 2025. It would be retroactive back to the beginning of the year. And that's the way most states, when they've decoupled from 280E, they've gone back to the beginning of the year. So that's one thing that we're advocating as a, as a society and as on behalf of all CPAs with Treasury and the IRS to consider. The other thing is that, there's been talk about, could they potentially bifurcate 280E and just make it, say it doesn't apply anymore to medical cannabis versus adult use. Our stance would be that 280E is 280E. Doesn't matter. It doesn't distinguish between recreational versus medical cannabis. So our stance would be that it applies to cannabis in general. So, we're putting all of this out there to the IRS and Treasury to really consider. I think everybody that practices in this industry knows that, there hasn't been a lot of guidance around 280E, and the IRS hasn't been putting any information out about guidance around 280E. So that is another thing that we're hoping that we can, as this transition goes through, to be able to provide more guidance in clarity to the rules surrounding cannabis, because again, it still will be illegal at the federal level. So with that, I'm going to pass it along to our next person here to continue on with our presentation.
Thanks, Dave. So in this part of the presentation, we'll be exploring how a more sophisticated tax planning would look like with rescheduling in the horizon. As Dave Bradley mentioned a couple minutes ago, if cannabis gets rescheduled to a Schedule 3, 280E goes away, and then now it opens up the opportunity for a lot of tax advantages and tax deductions that we may be able to claim down the road. Just from an operational standpoint, taxpayers will be able to take more deductions, hence that will give them a lower effective tax rate now that tax incentives are on the table. And then as a result of all of this, businesses can now revise their cash flow projections. And this could mean, expanding operations or having just conversations with the investors just to see what's going to happen with the excess cash flow. It's probably been a while since the shareholders got any returning capitals, distribution, dividends, or any of that sense. So that could be revisited once 280E goes away. What's going to happen with the excess cash flow? Are we going to expand into new markets? Are we going to spin the companies? Are we going to have new research opportunities, as Dave mentioned? But most importantly, it opens up the opportunity for tax strategy and tax credits and deductions that we haven't had in many years in this industry. So now let's go over to some deductions, and the most common ones that we can take advantage of, it's accelerated depreciation. You've probably heard us talk about consistency between internal books and records when taking depreciation. If 280E doesn't apply it anymore, now we can have some, let's say, inconsistency between books and records and take advantage of accelerated depreciation. So in hindsight, accelerated depreciation can come in two ways, in the way of bonus depreciation or Section 179. Let's cover bonus depreciation first. So essentially what bonus depreciation allows you to do, it lets you deduct 60% of your current year fixed asset eligible addition that you might have purchased during the year. And this code section is about to sunset in a few years, but we still have the benefit of this for the next couple of years. On the other hand, we have code section 179, and then that essentially allows you to deduct your eligible fixed asset addition entirely, 100%. And when I'm saying eligible fixed asset additions, that means your machinery, equipment, and qualifying improvements. So that could be, the qualifying improvements could be your ventilation, heating, cooling, and mostly internal design that's in a facility or a building. We do have some limitations when taking bonus depreciation in Section 179, which essentially it is, the limitation is that if you have an asset that has a useful life of 27 years and a half and 39 years, for tax purposes, you won't be able to do this. You won't be able to take this, you won't be able to make this election. However, how we can mitigate this, we can have a cost segregation study. So we'll have a certified person come in and then just essentially evaluate your building or your facility to segregate some of the building and into separate components. Essentially, that would place them hopefully on a lesser useful life where you can utilize bonus depreciation of 179. And at the end of the day, they'll help you decrease your taxable income. And then if you purchase a facility a couple of years ago, you still have time to do a cost segregation study, so you can always do it in the year that you need it and recapture some of the depreciation that you missed in any prior years. And so essentially you didn't lose that deduction. You're just kind of like deferring it and taking it when you decide to move forward into the cost segregation study, which is always helpful. In addition, we can take what's called Section 179D deduction, and essentially this benefits a lot energy efficient establishments, buildings, and facilities. And this really became popular with the Inflation Reduction Act a couple of years ago. But essentially, this deduction could apply to your facility if you have any interior lighting that you've done, heating, cooling, ventilation, and HVAC, that essentially reduces any energy in comparison to other buildings. But what 179D does, it's essentially a modified deduction that it's measured by the square footage of your facility. And some of the taxpayers can get up to $5.65 per square footage that qualifies for this. And your entire building doesn't have to qualify. You could take the deduction partially as well, which is helpful. You do need a engineering study to back up any of this deduction that we claim on the tax return. So we'll have to get a 179D study in place, but just so we can support all the documentation that's along with that. But also, again, you can do this at any point in time and recapture some of the costs that you couldn't take any prior year. So that would decrease your tax liability significantly in the year that you decide to move forward and make this election and have this study done. Another advantage we can take off is net operating losses. Net operating losses, if you have reported operating losses from operations in your historical tax filings, you'll get to carry those forward indefinitely and offset some of that income. You get to offset some of that current year income against those losses. You do have a taxable income limitation, so in the current year you can only offset up to 80% of your current year taxable income, and then if you have any other losses, you just continue to carry them until you fully utilize those losses. No carrybacks are allowed anymore under the current law, but that's still, you always take them forward, which is a great benefit to have. And then in addition, you can have them for state purposes as well. So you'll be taking it for federal and state purposes, which will decrease your tax liability, and your cash flow will go up just because you don't have as much of a tax liability. And then another one that we can take advantage of is the pass-through entity tax. This is an election that is available for our partnership and S corporation filers. And essentially what this election allows you to do is to deduct the state taxes that were paid by the partnership on behalf of the members at the federal level. So you'll get a deduction for that instead of treating that payment as a distribution as you would typically do, or you used to do it in the past. So they'll get factored into your taxable income, which will get reduced. And depending on where you're doing business, that could result in a significant savings. And there are a lot of states out there that would allow you to make this election. Massachusetts is one of them, Maryland, New York, California. So all the big states with significant tax rates will allow you to take advantage of this. So if you want to keep that in mind before the year ends, we can always explore this opportunity. Then let's talk about some tax credits now. So tax credits are typically a little bit better just because they decrease your tax liability dollar by dollar. But one of the most common ones in the industry will be the research and development credit, just because of the nature of the business. And then this credit is really driven by salaries and contractor expenditures for the most part. And typically, you don't need to create a new product to qualify for this credit. For example, you can just be developing a new strain, enhancing processes, developing new products within your entity, and then that could potentially get you qualified. So at the end of the day, we can see a lot of our manufacturers or cultivators just monetizing this credit just because the nature of the industry and all the research and development that goes along in those facilities. It definitely enhances your cash flow just because, as I mentioned before, it decreases your tax liability dollar for dollar, day in and day out. And then at the end of the day, you can always do it for state purposes as well. So that would be a benefit that you will take federally and at the state level. We can see some notable states that we have that we can take advantage of the research and development credit in Massachusetts, New Jersey, New York. So a lot of those states will conform with this. So if we continue, we can talk about the investment tax credit. So essentially, what the investment tax credit does, it encourages taxpayers just essentially to invest in tangible property. And it's truly a credit based on the current year fixed asset additions that you placed in service during the year. And the investment tax credit can come in many forms, but when it becomes really significant is when you have major and significant purchases for fixed assets during the year. So for example, solar. If you are dealing with solar energy or solar panels, that could really result in a really good tax credit, which could vary from 30% on the qualified property up to 40 and 50% of the qualified property, depending on how the deal was structured and even the location of where the panels and the facilities are. So this will essentially decrease your tax liability significantly at the end of the year. And in addition, if you have some of the equipment that would qualify for the investment tax credit, you could have a lot of this in your manufacturing, cultivation, and agricultural facilities. It could be just the equipment and how the equipment and machinery is operated and run by. And for example, some of the equipment might be operated with hydro. So that could potentially get you to qualify for this credit, and essentially they'll be reflected on your tax liability at the end of the year. And then especially nowadays with the Inflation Reduction Act, some of this credits can be transferred and even sold. If you can't utilize them or you just don't want to utilize them, you'll think it'll be better just to sell them off. You can always do that as well. So if you're planning on doing any significant fixed asset purchases before the year ends, just please make sure you talk to us, and we can navigate any nuances that we may have and how to maximize your tax planning for you. In addition, the investment tax credit, you can always take it for state purposes as well. It won't be to the extent of 30% credit, but at least, for example, in Massachusetts, you can take it 3%, which at the end of the day, it's reducing your tax liability anyways. So there are a lot of states that still conform with this and will give you credit for your fixed asset additions that you placed during the year. But yeah, so if you plan on doing any fixed asset additions, just please make sure you talk to us. And I think this is a good time for us to maybe just go to the next call and pass it over to Dave in case he has any closing remarks in this area.
Yeah, thanks, Tomas. So we see a ton of opportunity for tax planning once rescheduling happens, and we're really excited for it. You know, one of the things that Tomas had mentioned was the cost segregation studies. And we've done those, we've recommended clients do those for a lot of their cultivation facilities, not to take the bonus depreciation because you can't do it under the 280E provisions, but to get assets into a lesser life and maximize depreciation sooner rather than later. But I think what's really key here is that you can have a cost segregation study in a later year and recapture depreciation that could have been bonused. So we see this as a huge opportunity for some cash flow savings down the road once, rescheduling does come into play. And, I think it will be a lot of opportunity for some significant cash savings because of those cost segregation studies and additional bonus provisions. Now, the bonus provisions, if those of you who may have tuned in to our earlier presentation and yesterday's presentation on the post-election fireside chat, bonus depreciation currently is being phased out under the tax cut and the TCJA. We're hoping that, that those provisions do get extended. And we're thinking, with the new political landscape here, there's a strong possibility that that will happen, that the bonus provisions will be restored back to, 100%, where they're currently at 80% now. So, more to come on that. But I think, if bonus is not a option, 179 bonus, expense write-offs will be available as well. And that won't be just for cultivation facilities, but also for all of your retail operations as well, the assets that surround that. So, like I said, exciting things to come in the tax planning and opportunities for increase in cash flow. So, with that, I'm going to move on to our last session that we have here today, and that's with exit considerations.
Thanks, Dave, and thanks for the shout out on the fireside chat yesterday, where Rich Weiner and I had a good time discussing, and John Bloom, all the possible changes as a result of the election. And I think you're absolutely right. Rich was of the opinion that bonus depreciation will more than likely be brought back up to the 100% level. But obviously, we'll just have to wait and see what happens with Congress. So I'm going to be talking about some of the different exit considerations, whether it's an asset or stock sale, or taking advantage of the qualified small business stock, or perhaps an ESOP would be an interesting solution for many of our clients as well. I talk about exit considerations because it's interesting that, when medical marijuana was instituted here in Massachusetts back in 2012, and then recreational in 2016, in talking to all of those clients, we'd say one of the first questions I'd ask them in terms of startup was, what is your exit strategy? And they all said, oh, well, we expect to be in the business for maybe 3, possibly 5 years at the most, and then sell. Well, I'm not sure that's necessarily been the case. We're now going on 12 years since medical was legalized here in the state, and I think a lot of our clients are still in the business, but given the cash flow issues that we're seeing, would probably like to think about possible ways of getting out. Of course, within the cannabis industry, mergers take a lot of different shapes and forms, but it really always comes down to 2 different ways of exiting. It's either through an asset deal or a stock deal, meaning you can either sell your stock in your company directly to a third party, or you can sell the assets of your company to a third party. And each one of those have very different implications for you as a seller or for you as a buyer. Now, within the cannabis industry, stock deals are very common, and that's just because, dispensary licenses may not be easily transferable. And if I can't sell my license directly as an asset deal, then I've got to sell the company that owns that license in a stock deal. But the problem with a stock deal is that the buyer taking over your business is also inheriting all of your so-called sins. If you're not up to date on your taxes as a business, then the buyer who's buying that business could continue to be liable for those taxes. So as you're thinking about exiting and how to strategize for that, you want to make sure that you're staying compliant and that you're maintaining good standing with the government and that you're putting your best foot forward to those buyers when they're going through their due diligence to make sure that they're not, buying a significant liability. So an asset sale, like I said, is largely just saying, I'm going to buy your assets and your company will stay in place. Now, if you're a C Corp, that's not necessarily the most efficient from a tax standpoint as a seller because of the double taxation, meaning the C Corp sells its cannabis license or sells other assets to the third party. And the C Corp pays tax on that at 21% federally for the gain on that sale. But now all of that cash is still stuck inside the C Corp, and we've got to figure out some way to get it out to your shareholders or your investors. And that's typically in a dividend or a redemption, which is again taxed a second time at somewhere between 15 or 20%. From a seller's point of view, the asset sale is not necessarily as beneficial. From a buyer's perspective, they typically want an asset sale so that when they buy an asset, they can get a step up in basis in those assets and start to redepreciate those assets. Now, with 280E, that was not necessarily as important to those sellers. But I want to say that it's not a question of if we reschedule, but when we reschedule. And so if we see 280E go away, the asset sale may again be more desirable by those buyers. On the stock sale, again, it's great for the seller because I own shares in my company. I sell those shares to a third party. I pay capital gain on those shares at 15 or 20%. There's also a lot of other potential benefits of that. If I'm selling my stock, maybe that stock might qualify as qualified small business stock, which can allow me as a seller of that stock to eliminate up to $10 million of gain on the sale of that stock. And we're going to go into that in more detail in just a minute. It also, if maybe I'm not that QSBS, qualified small business stock eligible, so maybe what I'm doing is a stock for stock swap, where I have shares in my C Corp, I exchange them for shares in your C Corp. And again, we're going to go into more detail on that. So from a seller's standpoint, that's very beneficial. But again, from the buyer's standpoint, they're not as happy with that because they're acquiring the potential liabilities that your company comes with, as well as they may be missing out on some of that step up in basis in those depreciable assets. So when you're negotiating a sale, if your buyer is insisting on an asset sale, then you've got to make sure that you've calculated the tax ramifications of that sale to you and your investors, and perhaps talked about an increase in cost or an increase in the sale price to make up for the tax loss that you're incurring by agreeing to do it as an asset sale. So qualified small business stock. If you've been listening to me over the last 10 years, 12 years, we've been talking about its benefits and touting it as a terrific benefit to your investors, and it still is. Essentially what it says, if I have QSBS stock and I've owned it for more than 5 years, and I sell that stock to a third party, I can eliminate up to $10 million of gain on that sale. That's not a deferral, that's an elimination. So I'm not paying tax on that $10 million. And that's a significant benefit. And, with proper planning, we can multiply that $10 million out over multiple entities so that, maybe it's not just you, but it's your spouse or a trust for the benefit of your kids that each have that $10 million exemption. So in order to get qualified small business stock, it's got to be a C Corp. It can't be an S Corp. And I will say that C Corps became a lot more attractive back in 2017 with the advent of the Tax Cut and Jobs Act, which set a flat corporate tax rate of 21%. And luckily, that's not a provision that's set to sunset. We'll continue on with that 21%. And there's even talk of perhaps lowering it down to 18%. So C Corps have become a lot more viable, since the TCJA was passed back in 2017. And as a result, QSBS became a lot more popular and people talking about that. So if you're an S Corp, you don't qualify for QSBS. And if you're thinking about, well, I'm an S Corp, I'm just going to change to a C Corp, you've got to be careful about how that's done, because that stock that you've received has to be originally issued by the company. So if I'm just moving from a C Corp to an S Corp, or from an S Corp to a C Corp, then it's not necessarily originally issued, and that could be a problem. And as we said, you've got to hold the stock for more than 5 years before you sell it in order to be eligible for that QSBS. So, if you've got a stock option, you've got to exercise that option and own those shares for more than 5 years before you're QSBS eligible. And you've also got to be a qualified small business. And what is that qualified small business? At the time the shares were issued to you, the company has to have less than $50 million in assets, and 80% of the corporate assets have to be used in the conduct of that qualified trader business. And that really comes into play when we talk about what is that qualified small business. And for our cannabis operators, I just want to bring to your attention that a farming business is not QSBS eligible. So, if you're cultivating, you could be running into QSBS issues. And more importantly, less than 20% of your assets have to be used in cultivation. And so, if you're thinking that down the road, my shareholders are going to be eligible for QSBS on a sale, you need to be documenting very early on from the very beginning, one, that when those shares were issued, that the company had less than $50 million of assets, and two, that the assets used in the farming or the cultivation portion of my business constitute less than 20% of my total assets. Now, the good news is on your, what constitutes your total assets, that can include goodwill and intellectual property. So, we can help you with doing that analysis to ensure that, even if you're doing cultivation within that corporation entity, you may still be eligible. I will point out that, for a lot of our clients, we do put those cultivation activities in a separate LLC when we were talking about startup activities from the beginning. So the last topic that I'm going to talk about are tax-free exchanges. And I will say that we don't see that as much today as we did early on. Several years ago, we were seeing a lot of exchanges of C Corp shares for publicly traded Canadian companies. And the nice thing about that was, that if I'm exchanging my shares in my company for these publicly traded Canadian companies, I wasn't paying tax at that point. I didn't pay tax until such time as I sold those shares. The risk was that the shares that I'm receiving could fluctuate in value greatly, so I think that's why we don't see it as often these days, just because one, those publicly traded companies are not necessarily coming into the United States as much as they were before, those Canadian companies, and two, the sellers are more interested in getting cash rather than exchanging for stock that they may or may not be able to do anything with because of restrictions on the sale and the risk of the fluctuation of that value. With that, I am going to just mention ESOPs. ESOPs, employee stock ownership plans. We've been touting these for years. Unfortunately, we couldn't find an ESOP administrator or lawyer who was willing to work with us on this. Now we are, and we've had several clients who have already gone the ESOP route. The benefit of the ESOP route is if I sell my shares in my company to an ESOP, I can either defer the capital gain on the sale of that shares by rolling that gain into US stock or US assets, or if I'm QSBS eligible, eliminate the gain on the shares of my on the sale of my shares to an ESOP. And once the shares are owned by an ESOP, we convert that company to an S corp, and now the income earned by the company is completely tax-free. And so that's a significant benefit for our cannabis operators out there. They go from paying an effective 60 or 70% rate that Dave Gravel was telling us about down to 0%. That certainly makes you a lot more competitive within the industry. And even if we reschedule, we're still looking at a 30% rate on the C Corp level, which would be eliminated by selling your shares to an ESOP. And the last thing I will mention is if you do sell your shares to the ESOP and you perhaps eliminate the gain because it was QSVS eligible, or you've rolled the gain into US stock, you still have the opportunity. We can structure that ESOP sale in such a way that you can get that second bite at the apple. You can come back later and repurchase the shares if there's a second sale on the market to maybe big pharma or big tobacco after federal legalization. So with that, I would just encourage you, if you're interested, please talk to us about it. But I'll turn it back over to Dave for any thoughts he has on the subject.
Thanks, Josh. I do anticipate an uptick in M&A activity post rescheduling. I would encourage everybody to think about that and to plan for any potential exit strategy sooner rather than later. The earlier you can plan it out, ideally, we work with a lot of our startup clients to map out what is the best structure to have in place for a successful exit, as Josh mentioned. But it's never too early to think about exit strategies, and we're happy to talk to you about how how you can structure things to minimize the tax on the potential exit. So with that, we have gone through all of the sections here, and we don't have any questions. I'd like to thank Tomas and Dave Gravel, Josh and Janice for all of their insights that they shared today. And for everybody that is on Zoom, thank you for spending your time with us this afternoon. We understand everybody's busy and have a lot of things going on, but there is a lot to consider in terms of tax planning for 2024 and year ends coming up. And, we welcome the opportunity to talk to you about how we can map out a plan to minimize your tax burden for 2024 and going into 2025. And if you have any questions, please feel free to reach out to any of us and let us know how we can help.